Hello, today we will be discussing the topic, Can I get a loan to support my business? Here you will learn how and when to access capital to strengthen your business. Today's conversation will cover what is good versus bad debt, what questions should you consider when deciding to access capital, what are the different types of loans, and what questions should you ask your lender. Business debt can be both a blessing and a curse. On one hand, it can help you grow your business and realize greater profits. It can also create efficiencies to make your business even more profitable and resilient in the future. On the other hand, business debt also comes with risks. It can provide additional costs for your business long into the future that could make growth difficult or even impossible. Accordingly, when considering taking on business debt, it is important to consider why you need it and to develop a plan on how you will pursue it. During today's session, we'll take you through some of the questions you might want to ask before seeking business debt, as well as the different types of loans that you could pursue. Finally, we'll go over some questions you might want to ask when selecting a lender. So first, it's best to understand good debt versus bad debt. Debt can help or hinder your business success. To tell the difference between good debt and bad debt, you'll assess the level of risk involved as well as the likelihood of success. Good debt is generally any sort of debt that has a high likelihood of leading to increased future revenue and/or profitability. Profitability is how much money you have left after paying all of your expenses. This kind of debt is likely to offer a strong return on investment and help sustain your business resiliency into the future. As such, this makes the accumulation of debt for these purposes a lower risk than other types of debt. For example, let's say you're a family childcare provider and you have been in the business for years. You have a great reputation and a strong and loyal parent following. You have a long wait list and a number of parents asking you to expand your services, but you've already reached your capacity. You know of a potential viable location for a small center right in your neighborhood into which you could expand. Expanding your in-demand service to families in your area will enable you to increase revenue and profit for your business. In this case, the debt to expand your business can help scale your business growth. That would be an example of good debt. Bad debt, in contrast, is generally debt that is pursued that is unlikely to lead to increased revenue or profitability because you're uncertain of the outcome of the investment. As such, this type of debt is considered a higher risk since you might or might not see a return on this investment. For example, in the pandemic, some childcare centers under great economic stress took out loans just to survive a few more weeks. The investment was taken on simply to keep afloat. There was no plan to increase revenue or profit to repay the loan. These providers did not have a sense of how they would recover or be profitable, but took out the debt in hopes of buying time. In this instance, you might be able to extend the life of your business in the short term by taking out a loan, but without a clear plan to increase needed profit and repay your debt, the loan will leave your business in a weaker financial position than when you started. There's also unethical debt, which refers to business debt that is taken on for improper reasons. For example, if a business owner took on debt because they believe they can receive funds with a lower interest rate than through a personal line of credit, but do not intend to use those funds for business purposes, that would be an inappropriate use of a business loan. In addition to causing a messy financial situation, the business now has the additional stress of paying for a loan that doesn't increase the business's revenue or profitability. In a case like this, the additional economic stress on the business can lead to difficulties, if not closure, and the decision could bring with it potential legal troubles or bankruptcy. There are questions that you should consider. Regardless of the type of debt that you take on, it's important to thoroughly consider the pros and cons before jumping in. Taking on business debt is a big decision, so it's critical to think through everything beforehand, including your plan for repayment. To help you with this process, you should take a moment to answer the following questions. What am I going to do with the money? At the most basic level, you will want to start by understanding if these funds will fulfill a short or a long-term need, and as such, whether repayment will be short or long-term. Next question, are families willing to pay for it? When you think about the business growth, it's not just enough to think about what you want. You must also consider what you believe the market wants, or in other words, what the families in your community want and need. Consider our previous example in which a home-based childcare provider is interested in transitioning to a center within the community. In this instance, it would not be as simple as saying, I have a lot of families who are already using my services and others on a wait list, and then moving forward with the loan. You want to ensure that those families would be on board with your decision, or else the investment would not be as profitable as you expected. Do these families wish to move to a center with you, or do they prefer the home-based care that you already provide? Is the location desirable for them? Do the families on the waitlist feel the same as those already utilizing your services? It's important to write down whether or not you think families are willing to pay for your proposed change, as well as the evidence that you have support of. How much money do I need? Now that you have your vision written down, you can start to get an idea of how much money you need. This is not always as simple an answer as it seems on the surface. We recommend breaking out your costs into two general categories. First, how much startup money do you need? And then secondly, what's the long-term funding you will need? So let's take the example of the home-based provider who's moving into a center. In terms of startup funding, the provider may need to pay the first and last month's rent on their new facility. They may need some money to set aside to help renovate it before the center can open. Further, during the first few months that the center is planning on opening, the owner may need to invest in additional resources like an accounting system or a childcare management system. It's wise to budget for those resources and write them down individually. For longer term costs, the reality is that no business expansion is realized overnight, and long term costs should be expected. Because of that, in our example, this provider might wish to estimate the first 6 months of operation costs and factor those costs and anticipated revenue into the funding request. The provider should ask themselves, if I had to be ready to open my new center tomorrow, what would I need? They should also be certain that there will be adequate funds to keep the business running smoothly long enough to see the anticipated increase in generated profits. Next question, how is my credit? When thinking about applying for a loan, You will need to consider the credit that your business might have as well as your personal credit. It's wise to be aware of measures of credit strength and go into conversations to discuss a loan with open eyes. Even if your business has been around for several years, if your business hasn't taken on a business credit card or other loans in the past, you might not have a strong business credit history. Just like personal credit, banks can be leery of requests which are not backed by strong credit history because they cannot be sure that you can handle the credit. Many business loans will require you to secure the loan with your own personal assets and money. That means that your personal credit score may also come into play. If you worry that your credit history and score are not as strong as you would like, this does not mean that you should give up hope. As you pursue your loan, let the partners you're working with, whether it's Small Business Development Center, a bank, or a financial tech company, understand where you think your credit lies and why. This will help them assess which loans may be the best fit for you. And the final question, will I be able to repay the loan? There's clearly good types of debt that have lower risk and higher likelihood of financial gain, but keep in mind that any type of debt that you take on will become bad debt without a solid and certain plan to repay it. You will need to consider what the monthly payments will be and make sure that you can handle the financial burden until your debt is paid in full. In most cases, you will want to calculate how much extra money you will need each month to pay off the borrowed amount plus interest over a given period of time while still paying your regular business expenses. Determine where the money will come from and what you need to pay each month over the course of a year to have your debt fully paid off by the end of your loan term. An online loan payoff calculator can help make sure you have a solid plan to repay your debt in a timely manner to avoid any costly repercussions for your business. Now we'll discuss the different types of loans. Once you have a sense of whether or not you want a loan, how much money you will need, and how much existing debt you already have, you're going to want to consider the funding streams that are available to you. There are many types of loans, but this section of our session will cover the ones that are most commonly used to support family care and center childcare businesses. So first there's family and friends. One of the great misconceptions around business debt is that it works just like you see on TV. Somebody has a great idea for their business, they go to the bank gives them a big loan, they expand their business, and everyone lives happily ever after. When you look statistically at the way businesses gain the credit to grow, overwhelmingly the source of funding is friends and family. Friends and family already know who you are and may be likely to buy into your vision for your business growth. Connecting with family for help may be as simple as asking your parents for a loan or for a contribution to get you started. Another option for reaching out to friends and family who believe in your business could be crowdsourcing, as we've seen on sites like Kickstarter or GoFundMe. As the business owner, you can present your plan and funding goal to ask others for help. However, you should treat the agreement just like any other loan you might pursue, including some items that clarify key details of the loan. It doesn't have to be a 40-page contract, but you want to include points such as how much money you owe, whether it's the borrowed money you owe them, and if you'll also owe them a percentage of the profits of the business moving forward. You'll want to include in your written agreement the amount of each payment that will be made on the loan, the interest rate, and what portion of each loan payment, the principal versus the interest, that it will be. And you'll want to make sure that the amount that is due monthly is clearly outlined along with the total number of payments that will be made. There's also COVID Economic Industry Disaster Loans, also known as the EIDL. The EIDL was created by the US government to help businesses recover from extreme, unexpected financial hardship, such as a hurricane hitting the community or a massive flooding from a local river. The EIDL program was extended to businesses impacted by COVID-19 and continues through the end of 2021. This program offers low interest, long-term debt. That means that the loan typically comes with a lower cost and a longer period to pay it off. In terms of the EIDL, the program offers offers loans at a fixed rate of 3.75% for businesses and 2.7% for nonprofits over a term of 30 years. The EIDL funds, however, are not for expansion, but are for working capital, which means funds that help your business stay open and continue running until it reaches a point of greater financial stability. You can apply for a COVID-19 EIDL loan at any time by visiting the online application portal through the Small Business Administration. Then there's business credit cards. Business credit cards are a simple way to access funds for smaller, short-term, more immediate funding needs. For example, maybe you don't have cash on hand to pay for a repair, but you know you will by the end of the month. And so you could use your business credit card. A business credit card lets you start building your credit history as soon as you open the account, which will be helpful if you need larger amounts of funding in the future. The disadvantage of business credit cards is that they're typically offered at higher interest rates and may not provide access to the amount of money that you would need for a larger expansion or project. A business line of credit is from banks or other lenders and is another great short-term loan vehicle. It acts similarly to a credit card, but works for slightly longer term purposes. For example, let's say you're expanding your business and you need to cover 2 weeks of payroll while new families are brought into your care. In that case, you may want to use a business line of credit. The advantage of business lines of credit is that they're flexible. At any time after you're approved, you can withdraw funds from the line of credit up to the full amount for which you were approved. You do not need to use the funds immediately, nor do you need to use all of it at once. The other advantage is that you may only take out the amount you need. For example, if you have a business line of credit for $10,000 and you only need $4,000 temporarily, you can take out the $4,000 and only pay interest on that until you pay it back. And you would still have the remaining $6,000 available to draw in times of need. The downside is that you typically have a much higher interest rate on the amount borrowed because it is short-term debt. Because of that, business lines of credit are best for short-term or temporary costs to cover immediate needs that can be paid back in a relatively short period of time. Term loans are a very common loan structure. Many mortgage loans are set up in this way. There is a set amount that you're borrowing that must be repaid by the end of the loan term, which means that there is a time when the loan starts and when it has to be completely paid off. There's typically an associated interest rate that may be fixed or may be variable. That is, it may change over time. These types of loans are usually best for a very specific project or activity in which you know how much it's going to cost overall and you have a sense of how it will fit into your day-to-day business. Most importantly, you know exactly how long you will have to repay the debt. Your loan term could be 5, 10, 15, or 30 years, depending on its size and type. The interest rate varies based on your circumstances and the current economy. Term loans might be a good option for expanding your playground if you know that you can pay it off within 5 years, or even purchasing a commercial property and paying it off in 20 years. Term loans are longer term debt, which of course could put some strain on your business. The advantage is that you typically know what the recurring payments are going to be and can figure them into your long term budget. There's also several U.S. Small Business Administration loans, known as SBA loans. There's the SBA 7A loan, which is the most common and popular SBA program. It provides loans of up to $5 million. The funds can be used for working capital to keep your business growing, as well as expenses like real estate, equipment, and other purchases that you make to expand your business. Usually, the interest rates are somewhat low and the repayment periods are longer, about 10 to 15 years. One challenge to getting a 7A loan is that they typically go to businesses that have some established business credit history. If you need a loan with the SBA, the 7A loan is still worth talking about with your lender, even if you have concerns about your credit history. But it's worth being aware that this could impact your ability to qualify. There's the 504 loan, which are typically used to acquire or expand real estate. If you're looking to go out and purchase a new facility, including the center and the land, or you need to renovate a large playground, this might be a good option for you. The 504 loan usually requires you to show at least 10% of the down payment is going to come from your own business funds. The rest of the money can come from community-based lenders and other traditional banks supporting it. Lastly, there is microloans available from the SBA, and these are usually small loans for up to $50,000. Usually, these will come from community development institutions, not from commercial banks. And the average amount of a microloan is at about $14,000. Microloans are useful for shorter term projects, which don't require a whole lot of money, but the cost is greater than the limit on your business credit card. Microloans are often a good option for businesses that don't have much of a credit history because they are less difficult to get than other loans, like the 7A loan. And you've had questions that you should ask yourself. Now, here are some questions that you should ask your potential lender. Often, when a childcare business owner goes to get a loan, the meeting can feel very much like an interview, focused entirely on you, the owner. You will likely be asked questions about your credit history, business, and vision. This can create the illusion that everything is up to the lender to decide. However, remember that you also have the right to make sure that the lender is a good fit for your business. It's imperative to ask your lender questions to ensure that your specific needs are met. The right loan can tremendously help your business, whereas the wrong loan can damage or even end it. So here's some questions that you should ask your lender. Do you understand the childcare business? Does this bank truly understand your business, both where it is right now and the directions it can take in the future? Is this lender only used to working with other types of businesses that are not similar? Maybe they typically lend to factories in the area, and therefore they might not be able to understand your specific needs. Is the debt too short or too long? If a loan needs to be paid off too quickly, it could lead to bigger payments that can swamp your business. If the loan needs to be repaid over a long period of time, you could face higher amounts paid in interest on the loan. If the loan is for a long duration, you will want to ask if you can pay the loan off early without penalty, since paying off debt early can save you thousands of dollars in interest. What is the total cost of the loan, principal and interest? Interest rates do add up. Sometimes we look at the amount borrowed and at first glance and assume the monthly payment seems quite manageable. For example, let's say you have a minimum monthly payment of $300 and you feel confident that you can make that payment each month. However, that payment will include the interest due. You could end up with only a small portion of your payment going towards your principal balance and reducing the total amount that you owe. This could result in very large amounts of interest paid over time, and in cases where the loan term is not fixed, can leave you making payments for longer than you had originally intended. For this reason, it's critical to be aware of your interest rate and the total cost over time as you weigh the pros and cons of your loan options. When is the first payment due? In some cases, your loan payment could be due right away. In other cases, only interest may be due for a portion of your loan term, and the principal balance may be added to the monthly amount at a later date. Be sure that you're clear on when your first loan payment is due and what it will include so that you can plan accordingly. And the last question, how long will the application process take? You will want to understand what the application process involves, as well as how long it will take. Ask your lender what forms will need to be filled out, what documents will need to be supplied, and ultimately what the chances are of receiving the loan for which you are applying. You'll want to make plans accordingly while you wait for the loan decision to be made. Also, you should be able to weigh whether the time spent on the application will be worth it when you consider the odds of your loan application being approved. Even after you've answered all these questions, you should speak to current and past customers when you can. Ask the bank for referrals to people and businesses who they've worked with in your area, preferably businesses that are in the childcare industry, so that you can learn about experiences which are likely most similar to yours. Another way to learn more about potential lenders is to ask your friends and family to see if anyone has received a loan from this bank or institution before and what was their experience like. Understand that this information is absolutely critical to making an informed decision. Ultimately, it's not just the bank's decision, it's yours too. If you want to get more help understanding loans or thinking through some of the questions that you may have about lending, you can register for a free call with a Texas Child Care Business Coach at childcare.texas.gov. As you look at specific loans or feel that you're ready to go pursue a loan, you can reach out to your local Small Business Development Center. You can easily find your local SBDC by going to americas.org/find-your-SBDC and enter your zip code. The local SBDC will come up and you can reach out to them directly. For more tools and resources on other relevant business topics for childcare business owners, please visit childcare.texas.gov. There you'll find links to help and other resources in English and in Spanish. Also, you can sign up directly through childcare.texas.gov or send an email to coaching@ecebizcoach.org for quick questions or requests for coaching, which are also available in both English and in Spanish. Thank you.